Hi, everybody. It's another beautiful Saturday here in Santa Barbara. And with the Fed's announcement this week that they are indeed increasing rates by 3/4 of a point, I thought it was really prudent to talk about adjustable rate mortgages, right? What is changing? What are these options out here? Now, I've been in business for 24 years. It has certainly been that adjustable rate mortgage has been a great benefit to a lot of people in America, but you need to understand them. We need to understand how they change, what they mean for qualifying, and what are the pros and cons. So of course, Third Phase has done another fabulous PowerPoint. I want to share my screen. I want to teach you guys about this because we are all in it together. So let's figure it out, rock and roll from there, and let's go. Cheers. All right, so just about rate mortgages, how do they work? How do they qualify? And what do they mean for you? We are again making sure that adjustable mortgage has a place in the today's rising interest rate environment, right? This is a good idea, right? It can save you money. The initial interest rate is lower than a fixed rate, but it can indeed adjust. So let's talk about where we are and what we're getting into. So when we think of adjustable rate mortgages, we think of things that can change all the time versus a fixed rate, which is just very linear. The truth is there are a lot of parameters around them that make them safer. So what are adjustable rate loans, right? So these are known as ARMs. That's what we're going to call them throughout this little presentation. And these are those where the rates can change over time. And there's really two kinds. There's first mortgage arms, right? And these are typically fixed for a period of time and then adjust thereafter. And they have limits on adjustments. They can be fully amortizing, where you're paying principal and interest right off the bat, or they can be interest only, where you're just paying interest during that fixed rate period, but they're always principal and interest once they begin adjusting. And the second or your second mortgage loans. Now, these are typically HELOCs, home equity lines of credit, and these are fully adjustable, really based on prime, that Fed rate that did change this week. And there's also limits on these adjustments. And again, these are typically interest only during the first 10 years, which is the draw period. You can use it, repay it, use it, repay it, and then principal thereafter, or the remaining repayment part of the loan. We're going to really focus on the first mortgage arms. I thought that was kind of fun, right? So we're really focusing on first mortgages. I'm not talking about second line of credits, just the first mortgage. So how do these arms work? So these are really called a fixed period arm. Again, they're fixed for a period of time and then adjust, right? So there is a schedule on how these work. Now, typically fixed period arms today, there are a bunch of them out there, but let's talk about the standard ones are a 3/6, a 5/6, a 7/6, or a 10/6. These are fixed for that first numerator figure, 3 years, 5 years, 7 years, 10 years, and adjusts with the denominator, the 6 time frame, just every 6 months thereafter, right? So in a 3/6, you have 27 years of adjustability. On a 5/6, you have 25 years. On a 7/6, you have 23 years. 10/6, you have 20, right? So these are typically 30-year loans, but just there's a period of time that they're fixed and then they're adjustable. And every single arm out there have an index and a margin. So I tried to make this as color coordinated as possible. So index is going to be that orange, margin is going to be that red, and your index plus your margin equals your fully indexed rate. So the index is the part that changes. The Fed's prime rate is an index. That is what changes. The margin is the part that stays the same. Now, a margin is what is added to the index, so you get the fully indexed rate. Typical indices, again, are prime. This is what we're using for lines of credit. But right now, a lot of these first mortgage products are using SOFR, which is the secured overnight financing rate. So this is the cost of borrowing cash overnight collateralized by the US Treasuries. If you've heard me squawk about interest rates, I'm saying watch that 10-year Treasury, right? This is one of the reasons why. And this is collateralized by US Treasury securities in the repurchase market. So people are buying, selling them. And most lenders are using a 30-day average of this index. So yeah, it can change every night, boop, 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 but it's a 30-day average to give more stability. And again, that margin is the amount that's added to this index to get the fully indexed rate. And most margins right now, we're seeing at 2.5 or 2.75, and rates are always rounded up to the nearest 0.125%. So for example, so far I was looking that up today, it was a 0.77056. And if our margin is 2.75, we add those together and we get 3.52056. That's a funky number, man. So it's going to be rounded up to that nearest eighth. otherwise 3.625. And again, in all these scenarios, I'm trying to add colors for you so that you can see these. So that green's going to be that rate, the index is going to be orange, and then that margin's going to be red. So again, how do they adjust? Now we said what they equal the rate, but they all have caps. They all have limits on adjustments. And there are 3 adjustment caps for every type of ARM loan. There's the initial. So the first time it can change, that's the initial adjustment. There's subsequent. So every time thereafter. And there's the lifetime, which is the maximum, right? It can't ever change by more than this in the life of the loan. So even if the index goes all haywire, you've got these protections in place. These are limitations so that your budget doesn't go out of whack. Again, this is a first mortgage ARM, right? So the caps are set when we get the loan. They're not changed. Different investors have different caps. Different investors have different margins, but you can't renegotiate this after the fact. It's not like, oh, the market's changed. We're just going to give you something different. It is what it is, right? Now, rates can go up or down either way as the index changes. So it's very important to note that adjustable loans don't necessarily mean it's always going to increase. They can drop as well, but again, by these caps. And then the rate's actually never going to be lower than the margin, right? That's the floor. So if the index is 0, we still have the margin, 0 plus your margin equals your actual rate, okay? So 3 adjustment caps providing that perfect protection for you initially, subsequently, and the lifetime. So let's do some examples. Yay for color coordination, right? So in this example, we're doing a 7/6 ARM. So the note rate, that's the rate that we start out, let's say it's 5%. Let's say our margin is 2.5. And let's say our caps are 2, 1, and 6, an initial cap, a subsequent cap, and a lifetime cap. So our loan is fixed for 7 years and adjusts every 6 months thereafter. It can never be more than 11, right? That's that note rate, that 5% plus that lifetime cap of 6, that's 11. And it can never be lower than 2.5 because that's our margin, right? So at the first adjustment, if our initial note rate was 5% and then our initial cap is 2%, 2 and 5 equals 7. It can never be more than 7% at the initial adjustment. So let's just do an example where the index is 3% at the initial adjustment. And the rate, therefore, would be 5.5%, right? So index is 3, margin is 2.5, therefore we're at 5.5%. But let's take a different scenario. Like, what if the index was 6% at the additional adjustment? Well, the rate's still never going to be 7%, right? It can't move more than this because the cap would come in. So even though that index is 6 and our margin is 2.5, which equals 8.5, we know that 8.5 is more than the note rate plus the initial or that 2% cap. So therefore 7% is still that rate. That's that protection that you have in these adjustable products these days. So let's continue with this on, right? Again, using the same concepts at the top. Let's say it's now year 8. So we're ready for our second adjustment. And our last interest rate was 7%. Well, let's say the index dropped. Well, our new rate would only be 6%. So 3.5, right? That's our index plus 2.5, which are our margin. That equals 6. But what if the index dropped even more? What if it dropped to 2.5? Well, our rate would still be 6 because that subsequent cap comes into play, right? So even though our 2.5 or index and our 2.5 margin equals 5%, if we were at 7, it can't go up or down more than 1%. That's where these caps come into play. And because 5% is more than 1% of that adjustment from 7, we're only going to be at that 6%. So these are some of the caps the way, just examples. Again, a 3, a 5, a 7, a 10. These are the standard fixed periods, and they adjust for 6 months every thereafter based on these caps, the index, and the margin. So how do ARMs qualify? So this is something we really have to keep in mind because you're like, oh, cool, I'll take this lower rate. Austin sounds amazeballs, right? But shorter term ARMs qualify differently than longer term ARMs, right? Because the rate can change sooner than later. All loans are based on risk. We typically think of the risk as my credit score is lower, so my rate's higher, but it's everything on a loan file has to be taken into account, especially now, right? So a shorter term ARM is like 3 years, it's going to be here before you know it. 5 years, oh yeah, it's still a thing. 7 years, 10 years, the market might settle out, right? Averaging over time. So the shorter term ARMs, even though their rates may be lower, that are going to qualify different than a longer term ARM, and everything qualifies different than a fixed rate. So how do these qualify? So shorter term ARMs, these are examples. Every investor has different guidelines, but this is pretty much what you see out there in common. So a 3-6 arm is going to qualify on the greater of the note rate plus 6 or the fully indexed rate. Remember, the fully indexed rate is the current index plus the margin, right? Now, a 5-6 arm is going to be the greater of the note rate plus 2 or the fully indexed rate. Read in between the lines here what this means on that 3-6. If they're qualifying at the note place for a set, they're like, please don't take this. We think things may change, right? That's reading in between the lines. Now, note rate plus 2, that's a very common factor. So the note rate, again, is the actual interest you're paying during those first 3 or 5 years, right? So that's the note rate. So in the longer term arms, the greater the note rate or the fully indexed rate rounded to the nearest 0.125. Again, why? Well, they think that that longer period of time is going to give more stability. And arms always round up for qualifying as a worst case scenario. If it's a weird, funky number, it's going to be rounded up on the way that you pay it. So therefore, it's going to round up on the way that you qualify. So what does this all mean, right? Well, this means the rate you're paying doesn't always equate to how you're qualified, right? So in an example, let's say our note rate's 5, the index is 1, and the margin's 2.5. So therefore, that fully indexed is 3.5, right? But that 3-6 arm is still going to qualify you higher, right? So if our note rate's 5 and we qualify at the greater of the note rate plus 6 or the fully indexed rate, well, 3.5 is a heck of a bananas lower than 5 plus 6, which would be 11. We'd qualify at 11% here, right? Similar situation with the 5-6, right? Our note rate is 5% and our note rate plus 2 is 7. So the qualifying rate is 7%. It's the greater of these. It's the more conservative. Now the 7-6, the 10-6, it's the greater of the note rate or the fully indexed rate rounded to the nearest 0.125, again, because indices are always not whole numbers. So in these situations, you're qualifying on that 5%, that actual rate that you're paying. So what does it mean for me? What does it mean for you, right? It's all about that right plan. There's pros and cons to everything. Fixed rates, look, those rates will never change, right? It can be higher or more upfront because they're hedging for that longer term. The qualifying on a fixed rate is always based on the note rate because it can't change. But if rates drop, you have to refinance to get a lower payment. You have to get it refinanced to get a lower interest rate. But if rates rise, you're protected. No big deal. Now, adjustable rates can change in the future, but they still have those safeguards in place. Qualification is really going to depend on the product type versus the actual note rate. Again, those 3s, those 5s, those 7s, those 10s, they all qualify differently, right? It's not just the rate you're paying, it's how they qualify. Now, if rates drop and you're in that adjustment period, your rates drop. Cool, no big deal, right? But if rates rise, your rate could rise. So what do? Let's make some plans, right? So if you're curious on what opportunities these may have for you, let's connect. I'm Austin at Homeowners Financial. My phone number here is 805-869-7100. You can give me at austin@austinlamson.com, or there's a website as well. Thanks so much for the time, everybody. It's really, again, about knowing that plan, knowing together. I always want to make sure you have what you need. If there's anything I can do for you or anyone else, just let me know. Make it a great day. Bye.